Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
I'm excited for you to be a part of this presentation today. We're going to talk about a lot of different things when it comes to money, how to create different wealth strategies and change your financial future with different techniques, mainly around the idea of infinite banking. And there's going to be some, out of the box thinking when it comes to this strategy. So I want you guys, and I challenge you guys today to keep an open mind throughout this whole presentation, because I'm not here to sell you anything. I'm simply just going to show you something that I've been doing, our team's been doing, and we teach other people to do that's had a lot of success. And so today I want to kind of cut through some of the financial noise that we have in America in today's environment and talk about things that have been going on for a long time. Because there's been families throughout the past couple hundred years that have built serious wealth doing this strategy, and it's kind of under the radar. And so today, let's get into that concept. Let's talk about how to become the bank, which is something that usually doesn't make sense to people when they first hear it. And so today I want to kind of start by dismantling everything you've been taught and everything you think you know about money. And then it's going to take some time for the mind to shift. We're going to break everything down, and then hopefully I'll build you right back up the right way. And I say this because until you actually understand, until you can see what we're not seeing right now, it's not going to make sense what I'm going to explain to you towards the end. So a question I often ask people, and people ask me, is how do you become the bank, and why would I want to become the bank? I want you guys to think about those questions throughout this whole presentation as well. So the first thing I want to start with is something that is very important. It is control. I want to start with control because control is one of those things that in your life, if we're not aware of it, someone else will be in control of us. So there's three things I look at that we want to control in our lives. The first one would be time, because time is one of those resources that once it's gone, it's not coming back. So I think it's probably one of the most valuable assets we have and we want to control in our lives. The second one would be our mind or our mindset, because our mindset's one of those things that we literally can control every aspect of it. And so when someone else can control that, it's going to screw everything up for us. And the last one would be money. Money is something we always want to control. Now, when you guys think about those three things, which one in the chat box, let's hear it. What do you guys think? Which one would you want to address first? If you want to change anything in your life, what do you have to address first? Is it control over your time? Is it control over your mind, or control over your money? We got money in there, got mindset, time, one of each. I love it. I mean, all are important. So I love that. In my opinion, if we are trying to change something, I feel like it's your mind. Your mindset needs to be the first to change. Because if you don't control your mind, you can't control money. And if you can't control money, you can't control your time. So as we go through this presentation, let's talk about controlling our mind around money. So why are the wealthy wealthy? It's because they control these three things. So on this presentation today, I want to take you guys through a 200-year-old system that's probably the most powerful way of saving, creating, and preserving wealth than anything else. And it doesn't require, working any harder, any longer, or changing anything except where your money goes first and how you view banking. So let's start today with a little bit of statistics. You guys on this training, you guys here, you dedicated an hour of your time today to be with us, learning about something. And that's what I call being a part of the 5%. You're on this webinar, you're taking the time when most people didn't. And that's, genuinely, you should pat yourselves on the back for that. Most people won't do that. And when I look at this as well, I like to think about people who are young and people who are a little bit older. So when I think about maybe 118-year-olds, if I was to ask 118-year-olds, would you be wealthy and successful at the age of 65 when you retire? I bet you every single one of those 18-year-olds would say, of course, outstandingly, yes, I would be successful by retirement age. But something happens from when you're 18 to when you're 65 that changes the whole dynamic. 5 out of 100 people will be financially secure at retirement age. That's a quote straight from the Social Security Administration. These are the only people who will be financially secure and not wealthy, not successful, but secure. So think about that. Like in America, the land of opportunity and freedom and everyone being an entrepreneur, 5% will be successful, or not even successful, sorry, secure at retirement age. That means that 95% of people around us are going to be working until they're 70, 80, sometimes older, maybe even taking on 2 jobs at that age, not because they want to, but because they have to. Now, why aren't more people successful? Well, there's some mysteries of money that I want to talk about here. There's some wealth killers, and there's a mindset that has to be had to be successful. These 3 things here kill wealth building. When you have that hard-earned income, a portion gets taken out for taxes, then what you're left with, you spend on expenses, and then you have a little bit you save, and that little amount you save is going to go through inflation and volatility every single year, and who knows what's going to happen. It's very hard to become successful with those 3 things alone, let alone when you add people who want to follow the status quo. There's fear of taking risk, fear of investments, fear of change, and then life always gets in the way. Like, for example, COVID, no one expected that to happen, but it was a year, 2 years of chaos for most people financially. Things like that happen all the time. And even on a smaller scale, people, the little amount they save ends up getting spent on random expenses or things that pop up they have to fix. And that's just life, right? But so with all of these things combined, it is very difficult for people to become successful. So there's a quote I often think about by a guy named Will Rogers, this man here. He said, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. A lot of what we've been taught about money may not actually be the truth. And so I'm going to challenge the way we think about money today. And I want to start with a simple example and experiment. If you go on YouTube and look up the backwards bicycle, there will be an experiment. That's like the first video that pops up. Basically, it tests the theory of how you ride a bicycle and if you can change how you ride a bicycle. As a kid, we all learn how to ride a bike, right? When you move the pedals, you go forward. When you turn the handlebars right, you go right. When you turn the handlebars left, you go left. But what if I told you that that wasn't the truth? Well, in this experiment, they tested that. They switched the handlebars around so that when you went left, you actually went right. And when you went right, you actually went left. And this guy who was doing the experiment, he got up on the bike, he took a couple pedals, and he fell. He got back on thinking, of course I can ride a bike. This should be easy. Takes a couple pedals, falls again the other way. He does it for hours until he finally could figure out how to ride the bike backwards. And then he actually tried to go back to riding the bike the normal way. And then again, took him a long time to figure out how to ride it again because his mind had changed how the bike was supposed to be ridden. I bring this story up because when you learn something one way, it's very hard to change. And the same is true for money. Since we were little, we've been trained how to think about it. And so it's very difficult for us to change to a new way of thinking. but it isn't impossible because eventually you would learn how to ride the backwards bicycle. And this concept of infinite banking today that we're going to talk about, it's not something I made up or Steven or Chris Naugle made up. No, like this has been around again for 200 years. It's an old strategy. People like the Rockefellers, the Rothschilds, the Stanleys, the Morgans, they use this strategy to build their empires. And in today's modern world, people like Robert Kiyosaki, he talks all about this strategy in his book, Second Chance. You guys probably know this good-looking guy, Tony Robbins. Same with him. If you look in his book, Money Master the Game, in section 5, he talks all about doing this strategy. If you ever read this book, Becoming Your Own Banker by Nelson Nash, he talks in depth, step by step, exactly how to do this strategy. And then these couple books at the bottom here about my mentors, where they talk about how they use this strategy themselves. Any one of these books are great places to start when you learn about this. And if you want any of them, you can message our team and we'll send you guys these books. Before we get any deeper into this, though, I do want you guys to know who I am. This is my wife and I. This is Anna. We live in Southern California in Dana Point. For those of you who said you were an OC, we live in Dana Point by the beach. We love to travel. We love to go to the beach. We love to surf. We're all about it. And we're building our family right now. And we're building it through real estate was the first thing we got into. We've been buying real estate for a while now. And we've been using this strategy to help us buy real estate and accelerate it. And we've been put on a track now where we're going to create generational wealth. And so I'm fortunate enough to know about these strategies and these concepts early in my life, where now I feel like we just need to build on this and then be able to teach other people this and show them what I'm doing. And it doesn't, again, I didn't learn this from Chris, actually. I learned this first from my dad. This is my dad, Greg Herleen. It's him and I on the left. And then on the right, this is us filming one of our podcasts. We do a podcast called Generational Gains, where we talk a lot about real estate investing and business ownership from the perspective of someone who's been in the industry for a few decades and someone who's, in his first decade of learning this. And so it's a father-son dynamic. But he taught me about real estate. He taught me about raising money, about infinite banking, about, all these different strategies. And it's funny because I know most of you on here probably know Chris Naugle, and my dad and Chris actually have done webinars, businesses, investments together for over a decade. So I've been able to just watch these two guys control their wealth and build it, extremely over the past few years, and then start implementing the same strategies myself. And it's been insane. And so I just want you guys to know where I come from, how I got into all this. And these two guys right here are my mentors and have helped me really get into this. And it's cool now. I get to say that I'm a second generation infinite banker, which not a lot of people get to say. So I like to share that. So let's get back into the mysteries of money. First question for you guys in the chat. I see you guys being a little more active now too. So first question for you guys, what is the definition of money? I usually get answers, like currency, fiat sometimes. Some people bring up Bitcoin. What do we got? Instrument to exchange, a tool, value of exchange. Yeah, I love it. All those are right. Energy, that's a fun one. Yeah, money is nothing more than a means of exchange, a tool, right? Money, think about it. Money for food, food for money. Car for money, money for car. Money for house, house for money. It's nothing more of a means of exchange, right? So, and then if I was to ask you again, what companies are using compound interest? Kind of a different topic, and we talk about compound interest a lot. Most of you on here probably know what that is, but do you think companies and businesses use compound interest? Most people think banks do, Wall Street does, all kinds of people, right? Well, in reality, actually, most companies don't. And let's focus on banks because that's usually the most common answer. Banks don't make compound interest. They charge you compound interest, but they don't use it themselves. Because, for example, if I was to write Carson on a $20 bill and walk into my Wells Fargo bank account or bank, I gave it to the teller, do you think they would take that $20 bill, go in the back and put it in a box with my name on it? No. They put it in the back and they immediately lend it out. They put it into motion immediately. So we've been taught to park our money and leave it in someone else's control. But today that needs to change. Because if I had to ask you one question, are dollars worth more today or in the future? You'd probably tell me that the dollar is worth more today. Because if you were to go buy a candy bar with $1 20 years ago, you probably could have got multiple. Today, you can't even buy half a candy bar probably with $1. And then what about taxes? Are taxes going to go up or go down over time? And what's better? Would you rather pay tax on the seed or on the harvest? Taxes are always going to go up. And if they don't go up, they're just going to find more crap to tax us on. So wouldn't it make more sense to pay tax on the seed and not on the harvest? However, most of us don't practice that because if I had to guess, most of you people on here have a employee-sponsored plan like a 401k. And what you're actually doing with an account like that is you're giving up today's dollar in exchange for weaker dollars in the future. You're actually compounding the tax against yourself because the tax is always going to be there and it's always going to grow. And when you pay the tax on the money someday later, you're going to pay it on a much larger amount and not the seed from the beginning. So the funny thing is with that is that's just what we've been taught to do, is give up control of our money, put it in those accounts and let someone else control it until eventually we get it out when it's a higher, more taxed dollar and it's worth less. So we've been taught to do things with money that we wouldn't even actually do with things that money buys. For example, if I was to go to, I walk down to the grocery store, I live by one, 2 minutes away. I walk in, I buy a loaf of bread. I come home, open up the freezer, throw it in the freezer. Then I wait 5, 10, 20 years. And then I come back to the freezer, open it up, pull out the loaf of bread, and then want to eat it? No, I would never eat that bread because it'd be freezer burned. So what if I went and bought a car? What if I go down to my local Ford dealership, I go buy a nice truck. I drive it home, park it in the driveway, and I wait 5, 10, or 20 years, and then I get back in the car and I want to drive it? No, that's not what we do. So why would we do that with money? Again, we've been taught to give up control of our good dollars today for weaker, higher tax dollars in the future. So when I ask people about their retirement accounts, I'll tell you what you know. All you know is whether you have a conservative, moderate, or a high risk tolerance. And then you certainly know when you get the statement in the mail, whether the balance goes up or down. And that's about it. But to truly build generational wealth, we need to challenge some of those concepts and start learning how money really works. So let's dive into a couple questions I have for you. Again, what do we got in the chat, guys? What do you think of this question? Can you make money earning 4% while paying 6%? How does that math work? Is that even possible? Those of you who are veterans, a part of our community, our campfire, would know the answer. But those of you who are new, this question challenges a lot of you. Can you make money earning 4 while paying 6? Well, let's say, for example, I want to go buy a car, but let's say I have a $25,000 savings account. And my thought is, let's go buy the car cash. Let's spend my 25 grand out of my savings account, go buy the car cash. Now I don't owe interest on my loan, right? Awesome. Instead, I would say, well, let's put that 25 grand in a bank account. And right now, there are some banks paying 4% on high yield savings accounts. Let's just go with that number for this scenario. And let's say you're earning 4% at a really good bank and it's sitting in your 25 grand is sitting in the savings account. And then let's say you go to the bank and actually get a loan. Get a loan with the bank for 25 grand using this bank account as collateral. Because of course they'll lend you money. The bank, of course, would want to lend you money. But the bank would actually know that the truth is you would make more earning 4 than paying the 6% on the car loan. And I'll show you the math. And this, again, doesn't matter if it's 25 grand, 100 grand, 3-year, 5-year, 6-year loan. The math's essentially the same. So let's say, here we go. We have a bank account, 25 grand earning 4%. And then we get a car loan at 6% for 60 months. So a 5-year car loan, your payment would be $483.32 per month, which means you'll pay a total of $28,999 over the life of the loan. At 4% for 60 months, the future value of your bank account would be $30,525. Just simple math. So how is that possible? There's a difference between depreciating interest and compounding interest, especially when it's uninterrupted compounding. One account is going to slowly decrease, while the other is slowly increasing and eventually compounding on itself. So over that 5-year period, you would have actually made $1,500 in your savings account, more than you would have paid in interest for the loan. So yes, indeed, you can make more money earning 4 while paying 6. So let's start getting into infinite banking, or in other words, the money multiplier method, which is what we call it. There are 3 things that come into play when we talk about this. First would be the machine. We'll talk about the machine that we use to keep our money flowing. Second, we'll talk about the marathon. The fact that this concept, this strategy takes time. It's not a sprint, but it's a marathon. It's not a get-rich-quick scheme, but it will take a few years to fully build this strategy. The last would be the millionaire. What I mean by this is everyone's favorite topic, their goals, their plans, their future. Whether it's being a millionaire, a multimillionaire in today's market, being a business owner, having your time freedom, whatever that goal is for you, paying off debt even, that's going to be incorporated in the entire method. So let's start with a machine. What is the machine we use to build and create wealth? It's none other than a dividend-paying whole life insurance policy from a mutual company. Now, what the heck does whole life insurance have to do with building wealth? Whole life insurance is a scam, says Dave Ramsey. Whole life insurance is a payment for a death benefit that does not help you become wealthy. All right, that's what people think when they first hear this. Well, let's take a step back and look at who else does this. I mean, we already talked about it, but let's give you examples. Top left here is Mr. John Rockefeller. He created an empire and a massive family of wealth because he used the strategy and he ran all of his money through whole life insurance. Walt Disney here on the top right. I live 30 minutes from Disneyland. I go there probably once a month just for fun. And every time I come here, I remember that, well, Walt Disney, he started this place with a whole life insurance policy. Now he rakes in, I think I was looking at it, like $15 million a day at just Disneyland alone. The bottom right, these two billionaires here, you should know their names. It is reported that the ultra wealthy have over $1.2 billion in life insurance today. And these two politicians on the bottom left, whether you're Republican or Democrat, doesn't matter. Both of them use this strategy. Both of them are wealthy guys. If you look at Joe Biden's financial statements, when he became president 4 years ago, his financial statements came out and he had 4 whole life insurance policies on his balance sheet. So these are all good examples, but you know who the actual #1 purchaser of whole life insurance is in the world? Banks. You can look up BOLI, stands for bank-owned life insurance. To become our own bank, like I talked about in the very beginning, we need to mimic what the wealthy and what the banks do. And the banks have more whole life insurance than all of the land, all of their buildings combined. And why? Do you think it's because they're stupid or they didn't know something that we don't? Yeah, it's because they know something we don't know. We're not taught in school about whole life insurance. Yet banks and the wealthy individuals and families are having whole life insurance policies. And this strategy, like I said, it's been around for 200 years. Before our tax code was even invented in 1913, people were using this strategy. You can look at all these different banks' financial statements. I mean, Bank of America right now has over $22 billion in life insurance. Wells Fargo has over $18 billion. So why are they doing this? And let's talk about banks for a second. How do banks operate? How do they work? Let's say I have $100,000 and I deposit it in my bank account. And again, they're making 4%. Awesome return. I'm stoked with my savings account. They're paying me 4 while I have 100 grand there. And this number can be whatever you want, 10 grand, 100 bucks, whatever. If I leave my 100,000 making 4%, what's the bank going to immediately do? Lend it out. So let's say your neighbor down the street needs to buy a house and they're going to lend to, your neighbor Billy to go get a house, a mortgage loan, and they'll charge you 7% on that loan. What's Billy going to do when he buys the house? He's going to then pay the seller. And where's the seller going to put all their money? Back in the bank. And then what's the bank going to do again? Lend it out to someone else. Another example would be someone buying a car. Lend it out on a car note at 8%. Then what's the car dealership going to do when they get the money? Put it back in the bank. The bank's going to then lend it out again. Let's say someone wants a home remodel at 9%. They're going to pay their contractor, who's going to then put the money back in the bank. And one more example, let's say that someone else wants a debt consolidation loan. They're going to lend the money right back out at 12%. They're going to pay the credit cards off, and the credit card companies are going to put their money where? Back in the bank. So who's in control of every single one of these transactions? The bank is. All of them, they're in control. And they're constantly moving money to make money. So while you earn 4%, they make 7%. They make 3% more than you, right? While you make 4%, they make 8%. They're going to make 4% more than you. When you make 4%, they're going to make 9%. They'll make 5% more than you, and then they will make 8% more than you. If we total all of those up, they make 20% more than you did. So if we do the math, all right, well, you made 4, they made 20. Wouldn't you think, oh, they made 16% more than us? No, it's much worse. Because if you think about it, 4% goes into 20% 5 times. So they 5x'd your return. So they made 500% more than you did on your account that year. And that's because you were taught to give up control of your money. And how much risk did the banks take by doing all this? Some risk, but very little risk. You were the one taking all the risk by leaving your money somewhere. So if you look up BauerFinancial.com, you will see that banks make between 400 and 1300% on your money that you leave there every single year. You can pull up any bank's annual report and you will see how much they really make on the money you leave there. And if you think about it, when you go down to, any town, any main area in any city in the country, who owns all the buildings right on downtown, right on the main square? Usually it's banks, each one of the banks. And how do they have the nicest properties in town all over the country? It's because we're paying for it. So earlier when I told you that banks are the #1 purchaser of whole life insurance, and these specially designed whole life insurance policies, the thing I said was, are the banks stupid or do they know something we don't? Well, now you can see they're smart. They know something we don't. And they understand statistics. They understand how Americans use and treat their money, which is why they're so profitable. This is how people spend their money. This is the annual pattern of spending. Usually, we spend about 20 cents of every dollar we make on automobiles, payments, gas, upkeep, all that kind of stuff. We usually spend about 30 cents of every dollar we make on housing, mortgage payments, HOA fees, that kind of thing. We spend about 40 cents of every dollar we make on everything else. Travel, entertainment, food, right? All that stuff. And that leaves us a solid 10% to save. And actually, as of today, that savings rate is closer to like 5%. So it's much lower than this. And when most financial advisors meet with you to show you and help you build a retirement plan, they're going to talk to you guys about the money you save and how much risk you want to take on the money you save. And to get a higher rate of return, usually it's going to require more risk. Well, if you can't save more money and you don't want to take on any more risk, then what options do we really have? How much more risk do we really want to take with the money we make? So I'm not going to talk to you guys today about how much you're saving and tell you to save more. That's great, of course, but I'd rather talk to you about how much you're spending, because I'd rather take some of the money you're spending and show you how to build wealth by simply taking back control of the money you're giving away. If you want to build wealth, look at where all your money goes and let's find a way to take back control of that money. And let me show you what that would look like. So if we're spending 10 cents on our savings, we spend an average of 20 cents on the automobiles. Usually about 5 cents of that goes to interest alone. So let's say we financed everything ourselves. We had none of these loans. We're not paying interest to other people. We're able to save more of the money we're spending. Usually around 5% of that, or 5 cents on the dollars you make, go to interest for the car. So let's say we change that. Let's say that 5% or 5 cents now goes to your savings. Your savings just increased by 50%. Now, we can talk about this, maybe another conversation, but talking about car loans, why they are good or bad, how many payments you have. The simple way I look at it is if you can get a car in 2 ways. You can buy it cash or you can get a loan for it. If you buy it cash, you spend all your money, all your saved up income on the car. Now you have a depreciating asset and your money's stuck in the car. You now lost the ability to earn on that money for the rest of your life. That money's gone. The option number 2 is to get a loan. And in that scenario, you're going to pay interest and make a payment for 60 months or more or less to get the car. And then again, the money's gone, never to be earned on again. So when we're doing this strategy, we want to purchase those cars through our policy. And I'll get to some examples showing you that and why it makes sense. The next one would be housing. Usually we spend 30 cents every dollar we make on housing, and 25 cents of that goes to interest alone. It's a lot, right? So if we change that and we're able to save the interest we were paying on a mortgage, that's a massive increase of how much you can save. If you look at your most recent mortgage statement, I bet you over 80% of the payment goes to interest. So when they give you a 2%, a 3%, a 5% mortgage rate, and you're all stoked about it, look at your actual payment and how much interest you're paying. Over 80% is probably going to interest. So people get all hung up on the interest rate. I could care less about the interest rate. It's more about the volume of interest you're paying. And banks know that people move every 5 to 7 years, which is why they front load all the interest in those years. So let's talk about what everything else you do. 40 cents that you spend on everything else, usually 5 cents goes to interest. So let's say we change that interest and we were able to save that 5 cents instead of spending. Now look at that difference. We're saving almost 50% of our income just by changing who we were paying money to every single month and where that money was going out. So, like I said, I'll get to an example of buying a car through this strategy. And I see, Maria, you have a question. How do we take control and earn on our own money? That's what this is going to show you, this example right here. This is not my car. I wish it was, but I have a truck as well, and I like trucks. So I'm going to talk about how to get back all the money you could buy into a truck or a car, same example, how you can get back all the money for every truck you ever buy, drive, and own. So let's start with the machine, this whole life insurance policy. There's a lot of numbers on this page we're going to get to in a second, so don't focus on it. Just hear my voice for a second. So in terms of the machine, there is a mindset shift that has to happen. This is a whole life insurance policy. You have premiums, but we have to change our mindset around that, because when we look at normal premiums for home insurance, car insurance, health insurance, it is a payment. It is a premium for whatever the benefit is, because most of the time that's how those premiums are talked about and what it usually is. But when you have a life insurance policy that is structured correctly for banking, which is what we're going to do, it now becomes more of a deposit. Because think about it, when you deposit money in the bank, you can go and use that money right away. You can take it right back out. It's liquid. And I've never met anyone that doesn't want to deposit more money in the bank account. So if your insurance policy is structured correctly, it is exactly that. And it is more like a deposit because you can immediately use it. So we need to change our way we think about premiums and our fear of having a high or low premium, or just around the premium in general, because it is now a deposit into a bank that you have access to. Another thing about this machine is your age. I saw some people in the chat saying you were in your 50s. Well, age does not matter. When you think about life insurance in general, you usually think age matters, and it does, because your costs will go up for a higher death benefit the older you get. But in this scenario, I'm not getting a life insurance policy for a death benefit. I'm getting it for the purpose of banking and for financing and high cash value. So if you're young or old, the only difference is going to be the death benefit's higher or lower. But that doesn't mean your cash value is going to be lower or higher, or your premium is different. We can build a policy for whatever makes sense within your situation. I have people who I'm getting policies for that are babies, parents on policies for their kids. And we've gotten policies for people in their early 70s. So there is some factor of age, but it does not really matter in terms of what we're trying to accomplish with banking. And that's where the death benefit comes into play as well. The death benefit is important. It's extremely important to have that for your family, but it is not the main reason we do this. So let's talk about the machine and how it works with buying a car. All right, so this is an example of someone's policy. They had premium deposits of 10 grand a year. They put it in the 10 grand every single year into their policy. His cash value over on the right side is how much cash value they had access to use inside the policy. And this cash value, whenever you take a loan from your policy, which is how you access the liquidity, it comes from your cash value. So this amount here on the right side just shows you how much cash value is available year to year to use. So let's say we want to buy a car in the third year. If you look at the cash value, it drops to 4,000 in the third year when it's increasing. 6 grand in year 1, about 12 grand in year 2, and then it drops to 4. That's because we took $25,000 out of the cash value, just so if there's any questions about that. So let's say you take out 25 grand to go buy a car. Now what are you going to do? Well, if we take 25 grand out to go buy a car, if we were going to go do that at the bank and get a loan, we were going to make a payment for the loan every single month. Remember, it was like $500 a month almost. Or if we're going to buy it cash, well, that means we're going to spend 25 grand today, give it to the car company, and now we're going to save every single month to rebuild our savings account. So either way, you're going to kind of pay someone back. Wouldn't you rather pay yourself back? So if we're going to buy a car for 25 grand, let's be an honest banker with ourselves, because if we would pay someone else, we should pay ourselves. So let's say we pay ourselves back $500 a month, which would be 6 grand a year. And let's say we pay ourselves back for 5 years, 60 months, just like you would anywhere else. You are now going to take 25 grand out of your policy and pay your policy back $500 a month, just refilling the account. You can call it repaying the loan, whatever you want. And you can pay this loan amount back really however you want, but we will get to that later. So over the first 7 years, you put 70 grand as premiums. You paid 30,000 back to the policy. So you essentially put 100 grand into this policy over 7 years, which is a lot of money. You also bought a car cash, so you can take out that 25 grand. And let's say your net injection into this policy was 75,000 after 7 years. Well, if you look at the cash value at year 7, it is $67,881. That means that after 7 years, you put in 75 grand, you have access to 67,000, which means you had access to 91% or 91 cents on the dollar of everything you put into it. And you have a car free and clear. Now, why does this happen? How is this possible? Because your premium dollars, everything you deposit into this life insurance policy, is growing. It is compounding interest every day of your life. Just like in the example of, can you earn more while making 4 than paying 6%? Perfect scenario. You're compounding on the interest every single month, every year for 7 years, and all the dollars you put in, and you're now just taking a loan against your policy to purchase something and paying yourself back. Which means while you're buying the car, paying yourself back, every dollar you put into it from the beginning is still growing for you. So after 7 years, you had access to 67 grand of the 75 you put in, 91% of what you put in. But I did tell you, you can get back every dollar that you put into it. So let me show you how you can do that. Let's go another few years. We look at years 8 to 12. So another 5 years of having the policy. And let's say you don't put any more money into it, which you probably wouldn't do, but in this scenario, it makes the numbers easier to understand. You don't put any more money into the policy after 7 years. And then you buy a car again. You take 25 grand out to buy your second car, because 5 years past your first car, you're ready for another one. Your wife, your child needs a car, time to buy the next one. Year 8, you pull out 25 grand from the cash value, you buy another car. Then what are you going to do? Pay yourself back. $500 a month for 60 months, just as you would pay back the bank. You're going to pay yourself back with interest, because why wouldn't you? After those 5 years, you've put in 0 as premium, 30,000 as a loan repayment, and you also took out 25,000 to buy the car. So we can say net injection into the policy during that 5-year period was 5,000. And if you look at these two underlined numbers here, after the 7th year, your cash value was 67 grand. But after the 12th year, your cash value was 91 grand, which means it increased from year 7 to 12 by $23,000. And you only put in 5, and you have a car free and clear. So you have a car, put in 5, and you grew by 23,000. You made money on your car because you bought it and financed it through your own banking system, this policy. And if we look at that on a bigger scale, you put in 75,000 in the first 7 years and 5,000 in the next 5. So 80 grand went into this policy. Look how much cash value you have in the 12th year, 91,000. So after putting in 80,000, after buying 2 cars, you have 91 grand left over. So yes, like I said in the beginning, this is a way to get back all the money for any car you ever buy, drive, or own. I just showed you how to do it with 2 cars. And look, it took 12 years. Again, this is a marathon. It's not immediate. It's not get rich quick. This is a way to finance things throughout your life over time in a much more efficient fashion. There are some rules when we do this. Rule number 1, pay yourself first. This person saved 10 grand a year in their savings account or in their 401k or wherever else they want to put it, CDs. Instead, they put it into their banking system first before they used the money, the policy. Second, they paid themselves back with interest. Third, they recycled and recaptured the interest. Would you agree that it's better to pay yourself interest than to pay the bank interest? Right? Like, why wouldn't you? So you'd get a lot more out of the interest if you paid yourself back. So that's what I mean by recapture. You're recapturing the interest you otherwise would have paid to someone else. So if this works for a car, what else does it work for? I'm going to give you another example here of something completely different. Paying off debt. Now, I don't know how many of you on here have debt, but even if it's as simple as you have 1 car and a mortgage, you can do this strategy. Or it can be more complex, and you can have tons of credit cards and all these other HELOCs or lines of credit you want to pay off. The concept will work the same for any situation. But debt is a very easy way, or this is a very easy way to pay off debt and pay yourself back and recapture a lot of the interest. So this is another person's example. This is a doctor we worked with. They were 45 years old. They were a chiropractor, actually. And he had 9 debts. These were them. Each balance, each payment, each interest rate, and how many payments he had left. He had over $470,000 of debt. It's a lot. I mean, I would assume most of you and anyone on here doesn't have that type of debt. So scale your numbers back. If it's, you have 50 grand of debt, completely different. This person also probably made really good money. He's a chiropractor, owned his practice, probably made great money. But as most people do, when you make more money, you spend more money. So he has a lot of debt. So it's all relative how much money you make or how much debt you have, because it's all about how much you can save. It's not about how much you make. Some people who make 50 grand a year can save more money than someone who makes 500,000 a year and has a lot more debt. So just keep that in mind as well. This can work for any situation. But for this person's scenario, he was paying $5,700 a month in debt payments, and $69,000 a year was that total. So that would have taken 19 years for him to pay all that off. A long time. And he was fine with it until he learned what we could do. So he came to us and said, hey, I save 25 grand a year, about 2 grand a month. And that's because I usually have some extra cash, or people who pay me via cash or checks, and that doesn't get sent to my bank account. And it's just extra money I have. And that 25 grand a year, I want to save. And he said, well, how about, well, we told him, how about you save that 25 grand in your policy, not a bank account, or not just spend it on your debts. Let's save it first in our own banking system. Let's pay ourselves first, which he did. So he put 25 grand a year as a premium. He then immediately had access to his cash value of $14,000. So he took that 14 out immediately. And what he'd do, paid off the first 2 loans and a little bit of the Nordstrom loan, which meant he just paid off 2 cards where he was paying what, $161 a month and $287 a month, I think it says. So about $500 a month he just freed up because he paid those 2 debts off. So now what's he going to do with that $500 a month? Well, let's pay ourselves back with that amount. So that's what he did. $448, that's the exact amount. He started to pay himself back, and now his debt payments decreased to just $5,329 per month. So now he has $448 he's saving, and he's putting aside in his checking account every single month, just paying himself back. So that in year 2, he has that money ready to pay down these debts again and run through the policy. So year 2, 25 grand as a premium. Again, 16 grand is available to him in his cash value. It's a little bit more than the previous year because remember, he was earning interest. And he paid himself back $448 a month, which was $5,374 for the whole year. So if we add the cash value and his repayments together, he had access to about 22, a little more, or yeah, more than 21 grand at the end of the year, which he used to pay off the next 3 debts, which means he freed up payments. $922 on the private loan, $271 on the credit card, $276 on the other credit card. So now what's he going to do with those dollar amounts each month? Pay himself back. So now he's able to save $1,900 a month. And he's only spending $3,800 a month in payments. Following year again, puts in 25 grand as a premium. The cash value he has access to is $25,000 because again, he kept growing in his policy. And then he repaid himself $1,900 a month. So he had access to 23 grand by the end of the year in that account. So the total money available in this 3rd year was $48,000, which he then took out, paid off the BMW, the boat loan, and some of the condo. So what's he going to do in the 4th year? He's going to still keep paying himself back. He has a lot more now, $3,600 a month he can repay himself, and he only has $2,100 a month in payments. So let's recap that real quick. Talking about this being a marathon, right? It takes time. Well, how much did he put in over those 3 years? 25, 25, and 25 as premiums. Total of 75 grand. He also took out loans from his policy. First year, about 14 grand. Second year, about 16. Third year, about 25. He took out $55,000 as loans from his policy. So how much is left in the policy? Is it 20,000? Because 75 took out 55, 20 grand left? No, because remember, he was growing on the entire premium dollars. 75,000 is still in the policy, earning and compounding. Remember, we're not taking out the same dollars we put in. We're borrowing the money that we've put into the policy. Basically, we're putting up our money as collateral in an environment where it's growing, and we're taking a loan against it to go do these things, like paying off debt. So he still has 75 grand compounding growing for him, which is why you will see every single year the cash value increase more and more and more because he has so much growing for him and it's just compounding on itself. So the 4th year, what's he going to do? Put in 25 grand. His cash value increased by 26. So more than what he put in. He saved himself $3,600 a month, which was 44 grand at the end of the year. So he had 70,000 to pay down his condo with, which he did. Didn't pay it off fully, so he still has those payments. So nothing really changed in that year. But now he only has, you know what, 187 grand of debts left in just 4 years. That's legit. That's awesome. Right? He's almost done. 5th year, 25 grand goes in. 27 is the cash value. Still paid himself back 300 or 3,600 bucks a month. That's 44,000 a year. There you go. 20 or 71,000 available to pay off the condo, most the house. Now he just has a little bit left. Now his payments changed again. No more condo payment, which he's now going to pay himself back with that as well. So 4,556 bucks a month he's paying himself, saving, and then $1,200 a month of debt payments he still has, just a house. So in the 6th year, something changed a little bit, and this will happen for everyone's policy. Things change over time. There are actually, I guess, contribution limits. There's a max amount of money you can put into a policy year to year, depending on how we structure it. And in this guy's situation, he had to decrease his contribution amount from 25 grand a year premium. He had to drop it to 10. So you'll see he only puts 10 grand as a premium, but his cash value continues to grow exponentially. And then he also came to us and said, hey, well, this is going great. Can I set up another policy? I want to put another 25 grand a year into it. So he also got a second policy for 25 grand a year, but that restarted. That's year 1 of that new policy. So his cash value is still pretty small. So he put in 10 grand and 25 grand. He had 13,000 of cash value in the first policy and 14 in the second policy. If you can see, 6 years into the policy, he puts in 10, he gets out 13. He makes 3 grand on the policy, 30% on his money he put in that year. Whereas the policy that's year 1, he only had access to like 60% of what he put in. So it shows you over time, it does increase how much you have access to. He also paid himself back 4,500 bucks a month, just like he's been doing this entire time. Instead of giving that money to other people, he's keeping it and paying back himself. So he had a total of 82 grand, paid off the house. Took him 6 years to pay off all this debt, when it would have taken him 19. And remember, he's now going to keep paying himself back every single month. But now everything he's paying back is just savings. He can save so much more now and just keeping it in his policy. So what if I have no debt? What if you don't need a new car? Can you still benefit from privatized banking? Should you still want to become your own bank? Well, I'll tell you for myself, I don't have debt. I don't need a new car. And I do this all day long for real estate investing. So yes, you can do this if you don't have those situations. And that's actually where the fun begins. That's where you can really start to create a legacy, where you're buying businesses, assets, real estate through this policy. Now let's go back to that example real quick. And let's say you paid yourself back every month like you said you would. Well, for the condo and the house, you were going to pay $879 a month for another 250 months. And the house, same, 224 months left on that house payment. So if you're going to be an honest banker with yourself and pay yourself back what you would have paid someone else, you would keep making those payments every single month to pay yourself back. That would have been a total of $490,000, almost 500 grand over the next 200 months you would have paid to someone else's bank. But instead, because you did this, you are now able to pay yourself that back. And all of that 500 grand is yours, sitting in your pocket, all because you changed where you put your money first, the policy, instead of just going directly to the debt or to your savings account. Now that I showed you this, some examples, some numbers, should you do this? Should everybody be doing this? And why don't more people talk about this? Well, I mean, honestly, I probably would strongly recommend that most of you do something like this, small or large. If you continue on the same path that all of us Americans are groomed to follow, we're just going to steal from our kids and our grandkids like our past ancestors have done to us. It doesn't matter if you make $10 an hour or $10,000 an hour. It doesn't matter. This can work for you. And there are some qualifications to get this, but it can work for generally anyone. And why do the wealthy people do this? Because they understand how to keep money in motion, keep money in the family, and keep financing things in their own private bank. So we need to break those bonds of financial slavery that we're in. Otherwise, we're going to continue to be in debt. We're going to continue to not have success or build any real wealth. And we will be like the 95% of people who are not financially secure at retirement age. So when you do this, you're setting up not just yourself, but you're taking care of your family and those around you. When you use infinite banking, like we show you to, you use this policy, you're going to make that money go work for you. So if you're constantly trading time for money and not doing anything else, it's a vicious cycle and it's hard to get ahead. It's hard to actually build wealth without money working for you. So this whole concept is about control. And as we wrap up, let's talk about some other aspects of infinite banking that people always ask about. You decide how much to fund. That premium can be really whatever you want. These loans you pay back to yourself can be whatever you want. You have complete control. You can take loans and pay yourself back really quick, or over many years, or over 5 years, like the car example. You have complete control, and all those loans are free. Your policy is going to grow with those dividends and interest, and that is tax-free. The death benefit is tax-free as well, and that's what's going to create a legacy for your family to just accelerate and build this for themselves. These policies are safe. You're protected and exempt from any judgments or liens in most states. So not only is it growing for you, it's liquid for you, there's a death benefit, but you're protected. If anything was to happen to you, your money is completely protected. And lastly, you can use this for all kinds of stuff: retirement income, policies for your kids, funding college, funding businesses. So let's talk about how you can fund this. Well, these are simple questions we get a lot, and I'm sure you all have these, so we can hit them now. But you can fund your policy at whatever frequency you want: monthly, quarterly, annually, and you can change that at any point in the policy. The minimum and the maximum. Well, for your policy premium, I would recommend at the bare minimum, you do 10 times your age a month. And the maximum is going to depend on you, your net worth, and your income. If you're 50 years old, out of zero, that's $500 a month. That is the minimum I'd recommend you to do this with. And if you're younger, you can have a smaller premium as a minimum. And that's because you have more time for the policy to grow. So it all kind of evens out. Now, let's say you're doing $500 a month and you're like, hey, Carson, I also have 20 grand sitting in the bank right now. Can I put that into the policy also? Yes, you can. On top of the regular premium, you can do a large lump sum to start the policy and just front load some money in there. And you're going to have access to 60 to 90% of that total premium in the first 30 days. Immediately, you can take money out, which is why we call these policies high early cash value policies. It allows you to become the bank very fast. And let's talk about the policy loans real quick, because I get a lot of questions about these too. First off, your cash value in the policy is an amount of money that you have access to loan out. You can use the word cash value loans, policy loans. It's all interchangeable. It's the same thing. These policy loans are guaranteed. You can take a policy loan whenever you want and as many loans as you want, as long as there is cash value available. And I kind of almost look at the cash value like a line of credit. If you go to the bank and ask for a line of credit, if you take it out and then you start paying it back, whatever you pay back to the line of credit is available for you to use again. Same thing with the policy loans. And when you get a loan, there's no credit check, no approval process, no heavy paperwork. Ask and you receive the loan. And these loans are private, which is nice, because if you have a bunch of debt and your DTI is horrible and you're trying to qualify for a loan, what if we just use the policy, pay off all your third-party debts, get it off your credit report? Now it's in your own private bank, you have this debt you're going to pay back, but now you can qualify for a loan, right? So it gives you different ways to get other loans or accelerate using the policy. And I don't want to confuse this with anything, because you are going to keep bank accounts. You're going to keep getting mortgage loans. You're going to keep having a checking account. But the whole goal is to minimize how much you need to do that and maximize how much you can finance through your own private bank. And that's going to take time. So eventually you can run everything through your policy, but that's going to take years to do. So in the short term, let's find ways to take small wins. Let's maximize how much we can control, save as much as we can, pay off some debt. So in the future, we have more available to finance things throughout our life. And then back to those loan repayments, no minimums or maximums. You can pay it back when and how you want. You're in complete control. And if you miss a payment back to yourself, well, actually, it doesn't mean anything, because you're the one taking a loan from yourself. If you were to go get a car loan and stop making payments on the car loan, someone's going to come and take your car. In this situation, if you finance the car yourself, no one's going to come take your car. If you miss a payment, look at yourself in the mirror and tell yourself how you're going to pay yourself back. Maybe just take a month off and pay yourselves back in a few months. You're in control of how you do that. So why the money multiplier? Why me? Why our team? Well, I mean, first off, I use this policy myself, and our whole team does. We use this strategy ourselves, and we don't charge anything, not a dime, to help you do this. We get paid from the insurance companies for the business that we bring them, and we'll be transparent about that. So we're taken care of 100%. We will not ever touch your money, manage your money, use or invest your funds for you. You do this all yourself, really. We're just a third party to help you do this correctly and help build the right policy for your banking system. And I personally have met with over 2,000 families one-on-one over the past few years to show them how to build the strategy out for them. And between our whole team, Steven from the beginning, a few people in our chat as well, between all of us, we've talked and helped over 20,000 families learn and do this strategy. And I really like our team. I think it's unique because we have things that no other companies do. And there's not many people who teach this concept, by the way. But those who do, we're one step ahead because we have specialists for a lot of different things. We have software that we developed personally that no other companies have access to. And we have dedicated underwriters and some special policies at insurance companies that work for only our clients. I think that's pretty cool. I'm pretty sure as well, we are the largest infinite banking policy producer in the country. We are the top producers in most insurance companies that we work with. And that's because we have a lot of repeat clients and a lot of referrals because we treat our clients the right way. We aren't here to sell you a life insurance policy like insurance agents and financial advisors are there to do. We're here to show you how to become the bank. And that comes after your policy is set up, not because of the policy, but after you use it. And last thing I will say real brief is this gets a lot of attention. People will ask us, hey, well, I have an IUL or a VUL or term insurance. Can other insurance products be used to do infinite banking? And the short answer is no. IULs and term insurance are some of the highest paying commissions, which is why insurance companies push their agents to sell them when they really have no idea what they're selling. And so I'm not saying they're bad. It's just a different purpose than banking. So if you do want to have a more in-depth conversation about insurance products and what to use for infinite banking, we can talk about that on our one-on-one phone call. Now, to finish up here, guys, let's talk about something that's going to happen to every single one of us, guaranteed. One of two things will happen. We're going to live, and then we will die. Guaranteed. Not to be morbid, but that's the truth. Whether it's sooner or hopefully later, that's going to happen. And are we better off while we are alive with or without this? As you can see, we're definitely better off with this. We're going to pay off debt quicker. We're going to buy cars and get money back for it. We're going to go buy boats and houses. We're going to buy real estate deals and other investments. So we're better off with this. And then when we pass away or graduate, we sometimes say, is our family better off with or without this? Well, if you passed away, there's a death benefit on this policy, tax-free. I know that's not the main reason we do this, but that is extremely important. Your family will get a multiple of what you've put into it, paid to them tax-free. Whereas if you didn't have this, whatever you have sitting in a checking account is going to your family. There's a big difference. So yes, you are better off with this while you're alive, and your family's better off with this when you someday graduate. Last quote for you from my man, Warren Buffett. He said, if poor people would just do what rich people do, they wouldn't be poor anymore. Do you guys know what company he owns? Berkshire Hathaway, right? And what is that company? An investment company, but a portion of it is an insurance company. Why would he own an insurance company? Because he knows something most people don't. And he doesn't ever talk about it, does he? So if we could just do things that the rich people did, we wouldn't be poor anymore. And for those of you who aren't poor, which is hopefully a lot of us, it's not about being poor, but maybe it's about accelerating wealth building and being more confident and comfortable with what we have. So I want to thank you guys actually for being on this presentation. It's a little over an hour. Thank you for lending me your time, your energy, and focus on this. I really appreciate it. And you guys are not going to be like the 95% of people. You are going to be the 5%. These two QR codes on the bottom here, this left one, if you want to schedule a one-on-one phone call with me personally, and I can look at your situation and see if this would even make sense for you or how we could build this strategy out, I would love to do that. It would be a completely free phone call or Zoom, whatever you wanted. If you click that link or use your phone to go on that QR code, it will pull up my calendar and we can figure out some time to meet later this week. It also has the link above it, carson.bo.banker.com. You can look that up on your computer as well. On this right side, that is my Instagram handle. I don't know how many of you guys are on Instagram, but that's where I like to post a lot of my content every day, talking about different ways I'm buying real estate. I'm using this concept. I'm using my policies. And I just like to share with everyone what I'm doing. So if you want to follow me there as well, you definitely can. So there's a few questions throughout the whole presentation that I think I missed. We do have like probably 5, maybe 10 minutes left if we want to go over some of this. So if you have any questions you want to talk about right now, throw it in there. If you don't, then I'm sure we can hit your personal questions just on a phone call or meeting. Okay, I got a good question for you here from Tiana Richard. She said, I checked with my current whole life policy and they don't know what product that be used in this way. Okay. What are the policies called? How do we get dividend life insurance? Not sure I'm saying that correctly. No, I get your question, Tiana. So yeah, there's all kinds of insurance products and regular whole life insurance. There's like off the shelf whole life insurance. It's usually built for a death benefit. So like you'll have a payment, say, hey, I want to have $1 million death benefit. I am 40 years old. Here's my income, health, that kind of thing. They'll then give you a premium payment for that death benefit. And that's usually how life insurance policies are structured, is that right there. And that normal whole life insurance policy will have cash value from the premium, but it will take years, 5, 10, maybe longer years to actually have access to anything significant. So what we're doing when we build these policies for banking, we're actually using a regular whole life policy. The base of it is a whole life insurance policy, because we do have to pay for a cost of insurance and a death benefit and that kind of thing. But we maximize how much we put towards the base, and we minimize how much we put towards your cash value, which is an easy change. Any insurance agent, any insurance company can do that. But when we structure a policy that way, the commissions that are paid on a policy like that are significantly less. So a regular insurance agent who doesn't understand this and just wants to sell a life insurance policy, they're never going to give you a policy like this. They probably don't even know how to make it. But yes, any insurance company can do this. But if you do have a current life insurance policy, you can't change it to this new one. You maybe could roll it over. That might make sense. If it's super early, maybe you just stopped it and set up a new one. I don't know. It's a toss-up. Depends on the situation. But yeah, that's a great question. And another question from Joe. He said, what is the minimum lowest whole life policy you can buy? I don't know if you're asking about what's the minimum premium you can do or what's the minimum death benefit you can do. I'm assuming you mean premium. You can do as little as, like I said, 10 times your age a month. So if you're 30, $300 a month is the minimum I'd recommend to do this with. If you're 50, $500 a month. And the death benefit, probably, I think the minimum is 100,000. Can't do less than 100,000. I'm sure you could do less, but I mean, it'd be so small, it wouldn't be worth your time. So, and then again, when we're building the policy, I'm not going to say, hey, what death benefit do you want? Let's go find your premium. No, I'm going to say, well, based on your situation, here's what premium you should have. Here's how much money you should be running through your policy. Here's how much cash value we need to have access to. And then I'm going to send that to the insurance companies and say, hey, here's the policy we're looking for. Who can give it to us? And then they will then build a couple illustrations. I'll build them with them. We'll figure out the policy that makes the most sense. And then whatever the death benefit ends up being based on your age and your health and that kind of thing, it is what it is. I mean, I can make it higher if you want, but that just means there's going to be more cost of insurance. I'm going to really try and build the policy to be the most efficient cash value policy as possible. Most money available, most growth, least costs, which would mean you're going to have a lower death benefit. So yeah, it totally depends on your situation, but we can build a policy pretty small. It just depends on what you want. All right, guys. Well, there's no other questions in here, so I appreciate your time. I will be on here again next Tuesday. And so if you guys or your friends or family, you want them to learn this strategy just like you have, let them join next Tuesday. Have them hop on with us. We'll be talking about the same type of topics. And then if you want to have a personal phone call with me or my team, reach out to us and we can talk about it. And if you're not ready today, which I'm sure that's probably a lot of people, great. This takes a long time to learn. And even as I'm doing this, it takes me I learn something new every single month with it. So, if you don't have 100% understanding of it all, that's okay. I still don't. No one really does, because there's so many things that come into this. So over time, yeah, I'd love to help you with this. So just stay around our campfire if you feel like you want to keep learning more, keep watching our videos, and then you'll be able to hit that and do this someday. Let's see. If you are old, can you insure a niece or nephew? The answer is yes, you can. It will depend on your siblings and how much insurance they have, but yeah, you can. That QR code on the left is my calendar link. You can scan it with your phone, or you can type in that website right above it, carson.beyourownbanker.com. It'll take you to the exact same place. And then I see someone asking, how can you share this recording? I believe this will be reposted on Chris Naugle's YouTube page. I don't know if it's today or tomorrow or maybe later this week, but it'll be under the playlist Take Back Control Tuesday. That's what we named this webinar each Tuesday. So I would just check on it the next couple of days, see when it's posted, and then you can just share the YouTube video with your son. And yes, a brother can insure a brother, a cousin insure a cousin. You can insure and get a policy on anyone as long as they have some sort of insurability interest with you. Yes, family, siblings, kids, business partners even. Usually that's the extent of how far it can go. Sometimes a friend would work, but we'd have to figure out a situation there. All right, last question here, then I'll be done. This is related to Joe's question for a policy for my grandchild. I know one of the parents must have a policy, but what if they are not insurable? Do they have to be denied first? No, they don't have to be denied first. We can say, hey, insurance company, he's uninsurable, but the child, we still want to get insurance for the family. Can we insure the children? And then yes, we can most likely get that approved from the insurance companies. We'll just have to send them a cover letter in the beginning. All right, awesome guys. Well, I will see you here next Tuesday, and That was awesome. Thank you guys for all being here.